Hey, what is up everyone? In this video, I want to talk to you about the basics of dividend investing. And I want to explain to you all the different concepts of dividend investing. This video is not a strategy video per se. I just want to make sure that if you're about to get into dividend investing, that you're absolutely crystal clear knowing what you're going to get yourself into and what all the different little jargons and all those technical terms actually mean. If this is your first time here, my name is David. I do videos on personal finance and entrepreneurship. I remember the first time when I was just about to get into dividend investing.
I didn't know what dividend yields meant. I didn't know what payout ratios meant. I don't even know what the difference is between ex-dividend date and record date, not to mention what the heck are DRIP.
Now, dividend investing is such a hot topic right now, and I'm hoping that at the end of this video, you know all of the basics around dividend investing. Now, before we get started, I recorded this video on the day of Chinese New Year, which means I'm spending a lot of time with my Asian parents. And if you can smash that like button, I can at least tell them that doing YouTube is probably better than being an accountant. Without further ado, let's just get started. I know, my eye bags are crazy. It probably just means that I haven't slept for days because I had to create YouTube videos for you guys. And the coffee is to help me stay awake and not fall asleep during this video. Now, this brings us to the first basic, which is the types of dividends. Now, the three most common types of dividends are cash dividends, stock dividends, and also special one-time dividends. Now, let me explain each. Now, cash dividends are probably the most common kind of dividends, and it just means that the dividend is paid in cash. Stock dividends also very similar in the sense that instead of getting it paid in cash, you're getting paid in stock. Now, the only thing to pay attention to when it comes to stock dividends is that when you paid in stock dividends instead of cash, the total pool of stocks available have increased, which means that the value of your individual shares are diluted and therefore it's worth less than what they were before. And then the last one, which is a special one-time dividend, usually happens if a company is having a fantastic quarter or half yearly. Now, due to that exceptional result, the company have an option to choose to pay some of those earnings or net profit in the form of a special one-time dividend. There are more types of dividends, but those three are the most common types of dividends that you need to worry about. The rest is not very common. They still happen every so often. But if you're curious, just let me know in the comments below and type dividends, and if there's enough demand, I'll create a separate videos for that. Okay, now that we've got the types of dividends out of the way, one of the more common questions that's asked is the different dividend dates. Now, there are four main dates when it comes to dividend investing. There's the declaration date, there's the ex-dividend date, there's the record date, and there's also the payment date. Now, the declaration date is very simple. It's just an announcement from the company in terms of how much dividends they are paying, what are the ex-dividend dates, what are the record dates, and what are the payment dates. Basically, just a full announcement of that. Now, the second date is ex-dividend date. And that date is usually when you need to purchase the shares before that date to be entitled to dividends. Now, the third date is record date. The record date is usually a day after the ex-dividend date, and that's when the company checks on their record who is entitled to the dividends. And I'll explain the difference between ex-dividend date and record date in just a second. The last one is payment date, and that's usually the date when the company pays you with your dividends. There is a distinction between ex-dividend date and record date only because when you purchase shares from the stock market, there's usually a settlement period between 1 to 2 days before you become an official owner. That is why there's a difference between ex-dividend date and record date. But the most important thing that you need to know is that you want to purchase the shares before the ex-dividend date to make sure that when the company looks through its records, you're going to be an official shareholder and you're going to be entitled to dividends. Now, let me put dividend dates into a more practical example. Let's take a look at Coca-Cola Amatil in the Australian Stock Exchange. On the 22nd of August 2019, they announced that they would distribute a dividend of 25 cents to their shareholders. Now, within that announcement, they also stated that the ex-dividend date is on the 27th of August, and the record date is on the 28th of August, and the payment date is on the 9th of October 2019. That means for you to be entitled to the Coca-Cola dividends, you need to make sure that you purchase the shares before the 27th of August. Another really fundamental basic when it comes to dividend investing is dividend yields. Now, yields are usually shown as a percentage to the amount of dividends a company has paid for the entire year divided by the current share price. Now, let me put that into a more practical example. If a company for the entire year has paid $1 dividend and their current share price is $20, $1 divided by 20 would mean that the dividend yield is 5%. So if the dividend yield is 5% and you have $1 million in your portfolio,
I don't really know why you're watching this video.
but if you have $1 million in the beginning of that year, at the end of that year, you have $1,050,000.
And also, if you could give me some tips on how I can become wealthy, that would be really helpful too.
Let me give a more practical example. If the dividend yield is 5% and if you have $100 in your portfolio at the beginning of that year, at the end of that year, that portfolio will be worth $105. Now, another basic when it comes to dividend investing are dividend payout ratios. And dividend payout ratios are usually just a measurement of how much as a percentage of the company's net income is paid to shareholders in the form of dividends. And that formula is usually the amount of dividends paid divided by net income. Growing companies tend to have a lower payout ratio because a lot of their net income is reinvested into the company so that they can grow faster. And in the future, when they become more mature, then they'll think about distributing more dividends. Now, for a more mature company, like the big four banks in Australia, you'll find that the payout ratio is a lot higher because they're more established. Now, the one thing to pay attention to when it comes to payout ratios is that if at any point the company's payout ratio is above 100%, you need to be very, very careful about what you're investing into because the company is paying out more in dividends than its current net earnings, which is a huge sign that the company is in trouble and they're using these dividends, these massive dividends, as a way to keep the investors on board and not selling the stock. Now, one of the other really important things when it comes to dividend investing is dividend reinvestment plan. Now, when it comes to dividend reinvestment plan, which also stands for DRIP, it just means that when they distribute cash dividends to you, instead of paying you as cash dividends, the company is actually using that cash dividend to purchase additional shares that's equivalent to the amount of dividends owed to you. Now, because the company is using the cash dividends to purchase those shares, it's actually bypassing the transaction fees, meaning you get additional shares transaction fee free. And also because the company don't have to pay you in cash, like hard cash, that a lot of the shares that's purchased is at a discount. This is one of the main attractions of dividend reinvestment plans. One of the things that's really worthwhile noting is that because the company have distributed cash dividends to you and then use that cash dividends to purchase shares, the cash is counted as additional income for you, which means that you will have to pay tax on that. Now, another form of dividend reinvestment plan is dividend substitution share plan. Now, slightly different between dividend reinvestment plan because instead of declaring cash dividends and distributing the cash dividends to you, that never occurs. So instead of distributing cash to you, they directly just distribute stock dividends to you. So that means that the ownership of your stocks have gone up, but on your tax return, you haven't really received that income, which means that you're not paying tax, it's commission free. But the only downside to that is moving on to the future, you have to pay capital gains tax when you decide to sell those shares. Thank you for watching this video all the way to the end. I'm really hoping that at this point, you have a really good understanding of the basics of dividend investing. I know I haven't really talked about dividend investing strategies yet, or even an update on my portfolio, but I'm hoping to do that in the near future in the next couple of videos. If you really enjoyed this video, make sure you destroy that like button so that I can really show off to my Asian parents that doing YouTube is probably a pretty good thing. And if you want to see more content like this, make sure you subscribe to my channel and click on the bell so that you'll be the first to know when I release more new content like this. And until next time, thank you so much, and I'll see you soon.